Alrighty, welcome everybody. I appreciate those who are timely on time. Always great to reconnect. I'm going to give it a little bit more just so people could come in. I see more people are entering the room. So I'll just give it a few more moments before we kick off. Yep, we got an important topic here. See a lot of people are already. Okay. All right. Awesome. More people are coming in. Great stuff. Amazing. Always great to reconnect with you all. And if you guys are ready to roll, I'm ready to roll. Okay, fantastic. Always great to reconnect. And today's topic is going to be, what will your retirement income really be? Not just in the first year, but even subsequent years. What is it really going to be? And before I get into the material, let me just remind everybody that these classes, they don't happen in a vacuum. They happen because I have people supporting the work that I do. Those are my clients. Those are my members. If you know somebody who is a client or a member, give them a hug. Say thank you. And if you would like to become a client or a member, so the way you do so is you can actually request a meeting to meet with me and my team. The way to request that consultation is in the sidebar. I just posted a link and a button in the sidebar, so you could click on that button. It'll take you to a web page, and on that web page, you could request a one-on-one. I'm also going to post a link in the chat box. So anybody here who's looking at the chat box, you will have the ability to request the consult in the chat box as well. Here it comes in the chat box. There it is, a link. So if you're interested in meeting with me and my team, and we could talk about how we help federal employees, I'd love to connect with you. Okay, let us get into today's topic. What will your retirement income really be? I'm sure you guys have heard this before, that your retirement by design is relying on the three-legged stool. I'm sure you guys have heard this before, the three-legged stool. What are the three legs of your stool? So you have your FERS pension, you have your Social Security, and you have your thrift savings plan. Those are the three legs of the stool. Your FERS pension, I'm sure you all know this, that when you retire, OPM is going to send you a check every month for the rest of your life. How much money is going to be in that check? So that's going to depend upon how long you've been working, your high 3 average salary. That'll determine the gross number. But what about the net number? So we're going to get into that today for sure. And then the other leg, Social Security. When you retire, Social Security is going to send you a check every month for the rest of your life. We hope. We hope. And again, you may know the gross number, but what's going to be the net number? And then you have the third leg, your TSB. And the truth is, the third leg is not limited to the TSB. It includes your other investments as well. So for example, if you have IRA, if you have 401k, if you have brokerage accounts, so those get taxed differently. And your bottom line, your net income, may be different. And also your ability to draw money from them may be different. So we're going to talk, just practically speaking, what is your income going to be if you're pulling from the three-legged stool? So let's go through each one of these legs. I'm going to start off with your FERS pension. The first thing you need to be braced for is that when you retire, I know I said OPM is going to send you a check, but they're probably not going to send that check right away. What's going to start off is your interim checks. So the way it works is your interim checks start the month after you are deemed retired. What does that mean, the month after you are deemed retired? So the way OPM works is if you work a single day of a calendar month, let's say, for example, you worked August 1st. Well, because you worked August 1st, you are not deemed retired in the month of August. You're deemed retired in the month of September. And your first check, your interim checks, should start in the month of October. Okay? So just be prepared that if you retire early in the month or in the middle of the month, you're not deemed retired for that month. You're going to have to wait to be deemed retired the next month, and the pension starts the month after that. And even when the pension starts, it's not your full checks that they're going to send you. They're going to send you something known as the interim checks. And those interim checks are somewhere between, not my words, these are OPM words, somewhere between 50 to 80% of what your real pension check should be. 50 to 80%. So basically what that means is OPM is going to shortchange you. They're going to shortchange you for as long as they need to adjudicate your pension. I don't know if you guys ever heard this terminology, the adjudication of your pension. Basically, OPM wants to verify your federal career. They don't want to dare give you credit for a day that you did not work. That process of verifying your federal career is the adjudication process. And typically, the adjudication process, I would have told you, takes 2 months. That was what it used to be. However, that's assuming that OPM is not backlogged. And as we all know, OPM seems to always be backlogged. So that's why I tell people that they should assume that the adjudication process is going to take at least 3 months, at least 3 months. And that's assuming that OPM has an easy time verifying your career, meaning that's assuming that you have not much complexity in your federal career. But if you have complexity in your federal career, for example, let's say you were hopping from agency to agency, or let's say you owe a deposit or redeposit, or let's say you bought back your military time or you didn't buy back your military time, or let's say you got divorced. Anything that requires OPM to think, thinking takes time. It really does. And that's when you hear the horror stories of people whose adjudication process took 6 months or 12 months or 18 months to adjudicate their pension. 18 months. And remember, until they adjudicate, they're going to be shortchanging you. They're going to be shortchanging you. They're going to be sending you between 50 to 80%. So what you guys need to be prepared for is those 3 to 6 months or maybe even longer where they're shortchanging you and only sending you, let's just say, 50% of your pension. What's going to tide you over during that period of time? So what most people say to me is they say, you know what, Stefan, you're right. And during that period of time, I'm going to rely on my annual leave that gets paid out to me lump sum when I retire. Now, a couple of things about the annual leave. First of all, in a different class, for those who may have attended some of my other classes, I go into a strategy as to whether or not you should carry a big balance of leave into retirement, or should you spend down your leave as much as possible. And I present an argument that it's actually beneficial to take your target date, whatever date you were planning on retiring, and see if you could extend your service by spending down your leave. The reason why is because if you don't extend your service by spending on your leave, you're only going to get one benefit from the annual leave. You're only going to get paid lump sum. That's it. However, if you extend your service with an annual leave, you get 5 benefits. Number 1, you get paid for that annual leave. So it's 1 for 1. Number 2, you just added more service to your pension, so your pension goes up. Number 3, you're accruing more leave while you're using leave. Number 4, TSB contributions and matching for another month or 2, whatever, however long it is. Number 5, pre-tax FEHB premiums. As we will learn very soon, your FEHB premiums are no longer pre-tax once you retire. While you work, your FEHB premiums are pre-tax, but once you retire, your FEHB premiums are no longer pre-tax. So I could actually make a compelling argument that you should try to extend your service by spending down your leave. And if you do that, obviously, when you retire, you won't have a big giant chunk of annual leave to tide you over. So you're really going to have to ask yourself, okay, if I spent down my annual leave, or let's just say you didn't have much of an accumulation of annual leave. If you spent down your annual leave and you don't have an accumulation, so what's going to tide you over during that time? You may want to check your reserves. Make sure you can access either your investments, your TSB, which takes time to access your TSB. You may want to have some cash in the bank readily available. You just need to make sure you have access to funds, because while OPM is shortchanging you, you may need access to other money. Now, I have good news for you. When OPM finally adjudicates your pension, will they back pay you for all the money that they shortchanged? And the answer is yes, they will. Yes, they will back pay you for everything that they shortchanged without interest. That's just the way they operate. Okay. But my point is that everybody here should really brace themselves for those 3 to 6 months. I would say at least 3 months, and I may even tell you to err on the side of caution and say 6 months. And especially if you have complexity, you should definitely do the 6 months. Just make sure you have money to tide you over to make up for the other half of your pension that you're not receiving. Now, just a note about the annual leave. For those that are relying on their annual leave to cover them when being shortchanged, do you know how much money you're going to net from that annual leave? I know you think you're going to retire with a huge balance of annual leave, which, by the way, the maximum amount of annual leave you could retire with, it actually depends. For most people, you could carry over 240, and then over the course of a year, you have another 208. So 240 plus 208, theoretically, you could carry 448 hours. Okay, theoretically. Now, here's the thing. If you get paid out 448 hours, so then you're going to owe tax on that. Your tax is going to be withheld. Now, you might think that they withhold the regular rate of taxation from that lump sum annual leave. That's what you would think. Why would they change it? But unfortunately, that's not the case. When they pay you out that annual leave, they withhold a massive amount of taxes from that. And that over withholding is not going to benefit you until you file your taxes at the end of the year. They're going to withhold a massive amount. They're going to withhold close to 50% of that lump sum annual leave payout. By the way, there's actually a reason why they withhold so much. It's not a good reason. But it somewhat explains it. The reason is because when they pay you out that lump sum annual leave, let's just say they pay you it out at the beginning of the year, okay? And they're paying you out lump sum amount of $30,000, whatever your number may be. When they see that number, the payroll does an internal computation, and they say, wait a second, $30,000 is what we're paying this guy per pay period? Multiply that by 26 pay periods, this person's making like $700,000 a year. So because they assume you're making $700,000 a year, they have like one of the highest withholdings. It's outrageous. It's ridiculous. But my point is that if you're relying on your annual leave to tide you over, just be prepared. You're only going to net half your annual leave. You'll gross more than that, but you're only going to net half of that. Now, I mentioned the carryover amount is 240. That's for most people. However, if you're a senior executive, you have a 720 carryover. If you have foreign service, you have a 360 carryover. So there are different carryover amounts. But the point is, whatever amount of annual leave you retire with, brace yourselves, you might only get half of that. So right out the gate, I'm letting you guys down big time. I'm telling you that your first checks are going to be shortchanged. The interim checks somewhere between 50 and 80% of what your pension really should be. And the annual leave that you're expecting is going to be sliced in half because they're going to be over withholding taxes. So you really need to make sure that you have reserves in that transition year. By the way, with my clients, this is one of the important conversations in that transition year for my clients. We have to start calculating how much money are they going to need if there's a short change and where are they going to get that money from. Also, keep in mind, when you're looking at the interim checks, they do not contain your fake Social Security. So not only are they giving you only 50 or 80% of your real pension, but they're not giving you any of your fake Social Security. For those who don't know what the fake Social Security is, that's my nickname for the FERS supplement. Okay, I don't call it the FERS supplement. I call it the fake Social Security because it looks like Social Security, it acts like Social Security, but it's not coming from Social Security. That's coming from OPM. Okay. Fine. Also, your interim checks, they only withhold federal tax, meaning you're not going to have state tax withheld. You're not going to have your FEHB premiums withheld from your interim checks or your FEGLI premiums. No. Those withholdings are going to come only when your full pension starts. So let's think about this. If you have 3 to 6 months of interim checks, that means when the interim checks stop and you receive your full pension, you're going to have to back pay 3 to 6 months of FEHB premiums. They will withhold that. That's for sure. They're definitely going to withhold that. So just be aware of what's going to happen 3 to 6 months into retirement when you're finally expecting your full pension check, which is going to back pay you all the money they withhold. But unfortunately, while they're back paying you all that money, they're also going to recollect the FEHB premiums that they should have withheld, but they didn't. Okay, fantastic. Now, going a little bit further over here, your pension is taxable. At least most of it is taxable. There's going to be a small portion of your pension which is not taxable. Now, before we get into the small portion of your pension which is not taxable, let's just talk about the overall deductions that are coming out of your pension retirement. Then we'll get to the taxation shortly. But the overall deductions that are coming out of your pension retirement, let's compare them to the deductions that are coming out of your paychecks right now. So, for example, right now, you guys are paying into the TSB. When you retire, are you going to be making TSB contributions anymore? No, you are not. Can you? Can you make TSB contributions in retirement? No, you cannot. You cannot make new contributions into your TSB. The only way you can get money into the TSB once you retire is if you transfer money from an IRA into your TSB or from a 401k into your TSB. That you could do. Okay? But as far as making new contributions, you cannot contribute to your TSB once you retire. So that TSB deductions go away in retirement. Next, right now you guys contribute to the FERS retirement system. When you retire, are you going to continue paying into the FERS retirement system? No, you are not. Okay? So that's another deduction which is coming out of your pay right now, but is not coming out of your pay in retirement. Next, Medicare tax. Right now, you're paying Medicare tax on your income. When you retire, are you going to be paying Medicare tax on your FERS pension? And the answer is no, you will not. No Medicare tax is going to be withheld from your FERS pension because you're not going to owe Medicare tax on your FERS pension. That's great. Next, Social Security tax. Are you going to owe Social Security tax on your FERS pension? And the answer is no, you will not owe Social Security tax on your FERS pension. So I just identified 4 deductions which are coming out of your paychecks right now, which are not going to be coming out of your paychecks in retirement. The 4 deductions are your TSB contributions, your FERS contributions, and your sorry, I lost my train of thought over there. Your FERS contributions, TSB contributions are not being withheld from your pay stub. I lost my train of thought over there. Sorry about that, guys. I had a moment over there. Okay, let's come back on track. Speaking about deductions that are being withheld. So right now, you're no TSB, no FERS in retirement. Oh, no Medicare tax, no Social Security tax. Sorry, I lost my train of thought over there. Getting back on track. So no TSB, no FERS, no Medicare, no Social Security tax. Those are not being withheld from your pension in retirement. However, let's talk about other tax. What about federal tax and state tax? So now when it comes to federal tax, so this is something which catches people off guard. Most of your pension is subject to federal tax, most of it. However, there is a small portion of your pension which is not subject to federal tax. Does anybody know which portion I'm referring to? Which portion of your pension is not subject to federal taxation? And the answer is, it's the portion you've already paid the taxes on. Which portion is that? Your contributions into the FERS retirement system. You've already paid the taxes on your contributions into the FERS retirement system. And because you already paid the taxes, when you retire, they're going to give you that money back. And because you had the taxes paid on that money, you're not going to owe taxes again on those FERS contributions. Now, how much have you guys paid into the FERS retirement system? It really depends on when you were hired. If you were hired before 2013, you're paying like 0.8% of your salary. So for many of you, that's going to add up to about $35,000 that you paid into the FERS system. $35,000 is the amount that you've already paid the taxes on. That's for those people that were hired before 2013. However, if you were hired 2013 later, you're paying more into the FERS system. You're paying about 4.4%, depends upon when you were hired. 4.4% is what you're paying into the FERS retirement system. So that means you may be paying, closer to $100,000 over your career into the FERS retirement system. My point is, any amount that you pay into the FERS retirement system, when you retire, they're going to return that money to you. And because you've already paid the tax on it, you're not going to owe the tax on that money again. Now, how do they give you that non-taxable portion back? Do they just write you a check for the entire amount and give it to you all at once? Absolutely not. No, that's not what they do. Okay. What they do is they're going to stretch that money over your life expectancy. They're going to return it to you over your life expectancy. And when I say your life expectancy, what I really mean is for your life while you're alive. And that's assuming that you chose no survivor benefit. However, if you chose a survivor benefit, let's say, for example, you chose something for your spouse, so then they don't use your life expectancy, they use the joint life expectancy. So what I'm trying to say is that there's a portion of your FERS pension which is not going to be subject to taxation, not federal tax, not state tax, because you already paid the taxes on it. Now, here's the good news and the bad news. The good news is that OPM will calculate for you the portion of your pension which is taxable and non-taxable. That's the good news. Okay. However, the bad news is they will not do that calculation in the first year of retirement, meaning they'll do it in the second year and subsequent years of retirement. They will send you your 1099-R. They will tell you what portion is taxable, non-taxable. All that is going to be in year 2 of retirement and onward. However, in the first year of retirement, for some reason, which I don't understand, OPM does not know how to calculate which portion of your pension is going to be taxable and non-taxable. As a result of that, when they send you the 1099-R, believe this or not, this is so frustrating. When they send you the 1099-R, in the box of taxable income, it's going to say unknown. Unknown, because for some reason, they don't know what portion of your income is going to be taxable. It's really unbelievable. So the good news is they will give you the correct 1099-R in year 2 and onward. But the bad news is in year number 1, they're not going to do that. Okay? So just be prepared that there's going to be a portion of your pension which you're going to have to calculate in year number retirement, and that is going to be the amount that you do not owe taxes on. What that means is when you guys are deciding on your tax withholdings in the first year of retirement, so because OPM has this unknown amount, they're not going to be able to do the math much easier for you. You have to do the math on your own, and you have to guesstimate how much you should withhold from your pension in taxation. I know it's a little bit annoying, but in the first year, you may actually have to guess what should be your tax withhold. I mean, you could do an educated guess. There's ways to calculate what your income is going to be based upon your FERS pension, Social Security investments. You might be able to guess how much should be withheld, and then you're going to have to let OPM know. You should withhold X amount of money for federal. You should withhold X amount of money for state. Okay? Now, back on track. Let's talk about state tax for just a second. I mentioned to you that your pension is subject to federal taxation. But what about state taxation? Are you going to owe state tax on your federal pension? And the answer is, it depends which state that you live in. I'm sure you know there are some states that don't tax your income at all. Those are very popular retirement destinations, like Florida, Texas, Tennessee, Nevada, very popular retirement destinations. But then there are other states which do tax your income, but they exclude your entire pension from state taxation. They're federal pension friendly. Okay, there's a few states like that. New York, Pennsylvania, Massachusetts, Illinois. There's a number of states that are in that category where they don't tax your federal pension at all. Okay? And then there are other states which they do tax your federal pension, but they allow you to exclude a portion of your pension from state taxation. So I'll give you an example. In Maryland, for those that are age 65 plus, you're able to exclude, don't quote me on the dollar amount, I think it's around $39,000 of your federal pension from state taxation, which is pretty amazing because let's just say your federal pension is $40,000. You're able to exclude $39,000 of it from state taxation, which is phenomenal. Okay. Now, not every state is like that. Not every state is federal pension friendly. There are some states that are not federal pension friendly. So you definitely have to look on a state-by-state basis how much is going to be withheld. Now, we were in the middle of talking about deductions, so let's just collect what we just said. From your federal pension, you're not going to have FERS deductions, you're not going to have TSP deductions, you're not going to have Social Security deductions, you're not going to have Medicare deductions. So those deductions are not going to be there. However, you're still going to have federal deductions, okay? Federal tax, you're going to owe federal tax on your pension on most of it, not a small portion, not, but the rest of it, yes. And on state tax, that's going to vary state by state. But let us not forget that there are other deductions that come out of your pension. So, for example, some of you are going to be paying for a survivor benefit. Survivor. Some of you are going to be paying for FEHB. I think everybody here is going to be paying for FEHB. Some of you guys are going to have FEGLI, dental, vision, long-term care, for those who are getting long-term care through OPM. So those are deductions that continue even into retirement. By the way, for those who noticed, I didn't mention FSA, did I? The reason why I didn't mention FSA is because there is no FSA once you retire. Once you retire, FSA is over, game over. Now, we can have a separate discussion about HSA, but that's not for this class. My point is that aside from the federal taxes withheld, and aside from the state tax withheld, you still have plenty other deductions. Survivor benefit, FEHB premiums, FEGLI premiums, LTC feds, dental, vision, all those are going to be withheld. Oh, and here's a trick question for you guys. Of that list that I just mentioned, survivor, FEHB, FEGLI, LTC, dental, vision, of that list of 6 things that I just mentioned, only one of those is pre-tax when you retire. Does anybody know? Of that list, survivor, FEHB, FEGLI, LTC, dental, vision, of that list, which one of those is pre-tax when you retire? And the answer is the survivor benefit is the only one that's pre-tax. Everything else is not pre-tax. So again, when you guys are trying to calculate and forecast how much you should have withheld in taxes from your pension, don't think that your FEHB saves you in taxes. No, it does not. It does now while you're working, but not in retirement. No. Okay, last bullet point on this slide. When it comes to your full pension, your full annuity checks, so you will get a COLA at some point at the age of 62. But if you retire before the age of 62, just brace yourselves. There might be a year or 2 or 5 where you're not getting any COLAs. So, for example, if somebody here retires at 57 MRA, you're not going to get any increases, any COLAs on your pension until the age of 62. So just be prepared of that. So everybody here should be prepared for that first year is quite the transition year. Number 1, they shortchange you, right? Number 2, it doesn't contain your fake Social Security. They only withhold federal tax from your interim checks. When the real pension starts, they'll back pay you, but they're also going to withhold your insurance premiums. Some of your pension is going to be taxable, some of it's not taxable. Some of the deductions are pre-tax, like your survivor benefit. Everything else is post-tax. Okay, so a little bit of a doozy in that first year where you're trying to figure out what is your income really going to be? How much is it going to be gross? How much is it going to be net? Okay, fantastic. All right, that was the first leg of the stool, the FERS pension. The next leg of the stool, Social Security. So remember, Social Security only kicks in at the age of 62. For those that retire before the age of 62, you may get what I call the fake Social Security. What do I mean by fake Social Security? It's the FERS supplement. I call it the fake Social Security, as I mentioned before, because it looks like Social Security and acts like Social Security, but it's not coming from Social Security. What do I mean that it acts like Social Security? So check this out. It has an earnings test. Every year, you're going to have to file an earnings report. That's right. If you're making too much money, how much is too much money? So if you're making above this year, I think it's like 24,000 and change. Okay. I wouldn't be surprised if next year it goes up to 25,000 in that vicinity. Okay. But if you're earning above that $24,000 or $25,000, for every $2 above that, you lose $1 of your fake Social Security. It's just like the real Social Security. The same way with real Social Security. For every $2 in excess, you lose $1 of benefits. Now, I have good news for you. Most of your retirement income is not going to count as earnings. It's not going to count towards the earnings test. So, for example, your FERS pension is not going to count towards the earnings test. Your Social Security is not going to count towards the earnings test. Your TSP distribution is not going to count towards the earnings test. So most of your income is not going to count towards the earnings test. Okay, so that's a good thing. However, I have some clients that when they leave federal service, they get another job, and unfortunately, when they get another job, unfortunately or fortunately, however you spin it, when they get another job, they're going to be losing that fake Social Security benefit. So just keep that in mind. Okay. Next, the fake Social Security, it stops at the age of 62, no matter what. Now, one of the things we have to get into is when you turn 62, should you collect the real Social Security or should you delay? That's the next conversation over here. My point is, if you delay, so then that means that your fake Social Security got away and you decided not to take the real Social Security. So that means at that point, all you have is your FERS pension. Do you need any other income beside that? Because if you need any other income, where's that income going to come from? You're probably going to be drawing it from your investments. Now, this is a larger conversation, a conversation that we've had in a different webinar. And the conversation is, should you take Social Security at 62 or should you delay? Now, I'll spare you guys the effort of finding that old archive webinar and listen to it. I do have articles on this topic, but I'll just share with you guys my general recommendation is to take Social Security as early as possible. If you can take it at 62, take it at 62. Now, my recommendation assumes that you're not going to be working, because if you're working, there's the earnings test, and that changes all my calculations. That changes all my recommendations. But if somebody is not working, then my general recommendation is usually to take Social Security as early as possible. If you take it at 62, take it at 62. I'd rather you spend Social Security's money than spend down your own money. Okay, just the general rule I have. In general, I'd rather you spend other people's money as opposed to yours. Okay? Okay, back to the real Social Security. The same way your federal pension is mostly taxable, but there's a small portion that's not taxable, the same thing is true with Social Security. Most of it is taxable. There's a portion of it that's not taxable. So the way it works out for most people is that for most people, 85% of their Social Security is going to be treated as taxable income. 15% of the Social Security is going to be treated as non-taxable income. And thankfully, Social Security will send you the 1099-R. Yes, that is great. Okay, so this way, at least you will get the ability to file your taxes correctly from Social Security on that portion. Okay, now I mentioned that Social Security has an earnings test. The earnings test goes away at full retirement age. So that means if anybody here is working between 62 and full retirement age, which is for most people 67, if you're going to be working, just expect that you're going to get a reduced Social Security benefit. The truth is, if you're working, you might be making too much money. It might wipe out your entire Social Security benefit. So just be conscious of the impact to the Social Security. Also, very important to realize that when you turn 65, Medicare will start deducting your monthly Medicare premiums from your monthly Social Security benefits. Medicare and Social Security, they work hand in hand, okay? So anybody here who's going to be age 65 and collecting Social Security, Medicare premiums will be withheld. So that means you may notice a drop in your net Social Security pay once you reach the age of 65. Now, this is a larger conversation. Should you be taking Medicare at the age of 65? We've spoken about this in a previous class, and I'm sure you guys may remember my general attitude towards Medicare is most federal employees don't need it. Why? Because you already have FEHB, and FEHB is comprehensive coverage, and you're going to have FEHB for the rest of your lives. So most federal employees, I find, they do not need Medicare in addition to their FEHB. Now, they're going to have Medicare Part A, but Part A is the free part. It's Part B that's going to cost you money. And if you don't opt out of Part B, they're going to withhold Part B premiums from your monthly Social Security. So be prepared for that. Also, when it comes to Social Security, my general recommendation is to collect it as quickly as possible, as early as possible. However, I do have an instance where I tell people to do a very minor delay, okay? But not because I want them to delay and get more benefit in the future. No. I have a minor delay where I tell them to wait a few months and then request a back pay. So, for example, if somebody's going to be retiring towards the end of the year, let's just say retiring in September. So that means that they stop working in September and then they have a pension check in October, November, December. Now, if for those people during that period of time, they just made almost a full year's worth, 3/4 of a year, they were making full salary. So that means their income is relatively high that year. For the remainder of that year, I may tell them not to take Social Security and spend down some reserves that are underperforming. Meaning, I don't want you liquidating your stock for this. Okay, I don't want you liquidating your stock for this. However, if you have money sitting cash in the bank, I'm okay if you spend down that money cash in the bank. So what I'm trying to say is, if you retire at the end of September, so instead of collecting Social Security in October, November, December, what you could do is you could spend down some cash in the bank during October, November, December, and then in January, you could request a back pay for December, November, October, right? You could actually request those 3 months. You could request 6 months back pay theoretically, okay? At some point, it's just not going to be worth it, okay? But my point is that for somebody who's worked 3/4 of the year, they made a year, 3/4 of a year of salary, their income might be relatively high that year. I may want you to push your Social Security into the next year. And again, it really depends on how much your Social Security benefit really is, because if we're talking about a small amount, then it doesn't really make that much of a difference. But if we're talking about, a good amount of money, let's say a $3,000 a month, $4,000 a month of Social Security benefits that I could possibly delay into the next year, and then I could get back payment. So just a little bit of a benefit over there. Fantastic. Okay, next. We spoke about your FERS pension. We spoke about your Social Security. We spoke about your interim checks. We spoke about your fake Social Security. We spoke about your annual leave. We spoke about how you may need reserves for when OPM is gypping you and shortchanging you. Now let's talk about getting money from the third leg of the stool, which is your TSB. So when you take money from your TSB, you have a choice. And they give you the choice. The choice is you could choose a withdrawal from your traditional. You could choose the withdrawal from your Roth. By the way, that's good news. It wasn't always like that. I'm pretty sure before 2019, you had no choice. Meaning, before 2019, when you requested a distribution from your TSB, they gave you a combo of Roth and traditional money, which you may or may not have been interested in. Now, however, thankfully, you have the ability to specify Roth versus traditional. Now, let's talk about the traditional first. The traditional has a mandatory 20% federal tax withholding. So just be aware that if you request, let's just say $10,000 from your traditional TSB, they're only going to send you $8,000, and the $2,000, 20%, that is going to be withheld and sent to the IRS. So mandatory tax withholding. Now, is 20% going to be enough? That's where clients make mistakes. I had one client that took out a gigantic amount of money from their TSB all at once. And they said, well, I had them withhold the 20% taxes. I had to remind them that the amount of money that they took out from their TSB is not going to be taxed in the 20% bracket. There is no 20% bracket, right? I don't know if you guys know tax brackets. It goes 10, 12, 22, 24. Most of you guys in retirement are going to start off in the 22. Some of you are going to be the 24. And if you take out giant distributions, that may push you up into the 32 bracket. So just be aware that whether you're in the 32 or the 24 or even the 22, having 20% withheld is not sufficient. And that's just on the federal level. Don't forget state tax. They're not going to withhold state tax. That bites people, because they didn't realize it. And then at the end of the year, when they found the taxes, they see the larger state tax, the larger state tax liability. Now, if you want, you could send a tax payment to the state directly, or if you want, you could coordinate your state tax withholding from your federal pension to factor in what you're going to be withdrawing from your TSB. So it could be that you may want to up your state tax withholding from your federal pension just to make up for the fact that no state tax will be withheld from your TSB. Now, the third bullet point is a very important bullet point. This is something which I tell my clients, and you guys, again, you guys could use this as well. During the early years of retirement, I actually encourage my clients to withdraw money from their traditional TSB. Believe it or not. Okay. I know they can take money from their Roth, and I know that if they take money from the Roth, it's going to be zero taxes because that's the way the Roth is. It's zero tax on the growth in the Roth. However, I still encourage them to take their distributions from their traditional. Okay. The reason is because when you retire, you're going to be in the lowest tax bracket you may ever be in until the age of 75, when those mandatory distributions kick in. I say 75 because most people in this room is going to be 75. Some of you 73. But let me remind you, your traditional money, your traditional TSB, you're going to pay the taxes at some point. And if you look into your future, you may notice that when you retire, that's probably going to be the lowest rate of taxation you're ever going to pay. And if you wait into the future, you're either going to come back up into the current tax bracket you're in right now, or when those RMDs kick in, that may bump you into the 32% tax bracket. So I encourage my clients to withdraw first from their traditional TSB before they touch their Roth, before they touch their brokerage accounts. I usually tell them to withdraw from their traditional TSB while they're in the lowest tax bracket. This way they pay the low rate of taxation, and also by liquidating their TSB, it minimizes future required minimum distributions. Okay. By the way, if anybody here is entertaining Roth conversions, which we spoke about last month, whether you should or shouldn't do Roth conversions, if anybody here is entertaining that, the same motivation that you have to do Roth conversions is the same motivation you should have to be living off your traditional money, your traditional income in the early years of retirement. Okay. So if you guys, you have your pension and you have your Social Security and you need additional income and you're wondering, Stefan, where should I get that additional income from? I'm going to encourage you, like I do my clients, to get that additional income from your traditional. And if you take it from your traditional, just remember, they're going to withhold 20% tax, which might not be enough. And remember, they're not going to withhold state tax. Also, keep in mind that your traditional premiums, your traditional withdrawals, are treated as income, which counts towards your Medicare premium calculation. Now, as I just mentioned before, you might not even need Medicare, but some of you are going to ignore me and you're still going to get Medicare because you just like paying more money for your Medicare premiums. Well, if you really like paying more money for your Medicare premiums, I have good news for you, because your Medicare premiums are going to jump when you turn age 75 and those mandatory distributions kick in. When those distributions kick in, there's a very good chance you're going to be bumped up into a higher or 2 brackets higher on the Medicare premium chart, maybe even 3, depending upon how large those mandatory distributions are. So if you really like paying Medicare premiums, I'm going to give you an opportunity to pay even higher Medicare premiums in the future. As you can see, I'm joking. This is one of the reasons why I encourage my clients not to take Medicare, but rather just rely on their FEHB. But my point is, by you liquidating your traditional accounts early in retirement, that could at least minimize your future RMDs, which will hopefully keep your Medicare premiums down if you decide to have Medicare. Okay, so that's if you draw from your traditional. Then if you draw from the Roth, there's zero tax on your Roth withdrawals, zero. Okay, which, let me skip to the next, to the third bullet right here. Because there's zero tax, I would like for you guys to let your Roth grow. Because if there's zero tax on the growth, the longer you let it grow, the more growth happens, and you're going to owe zero tax on it. Also, what's nice about Medicare, about Roth withdrawals, is that it does not count towards your Medicare premiums, your modified adjusted gross income. So early in retirement, I'm going to have you guys draw from your traditional accounts. Okay. We'll see if we could even deplete those accounts as much as possible, either through withdrawals or through Roth conversions. And then your Roth money, I'd like for you guys to let that grow, let that ride. Later in life, you'll take that money out, or maybe not, and you'll leave it to your kids tax-free. Now, As much as I love the TSB, let me just point out the TSB has issues. The problems with drawing from your TSB is that you cannot specify which bucket you draw from. Now, for those who don't know, this is a conversation we've had in a previous webinar. When you retire, we can't be naive. We know that the stock market is not going to always go up. It's sometimes going to go down. But what I try to remind my clients is that the stock market going down is not intrinsically bad. It's only bad if you needed that money right then when it was down. But if you didn't need that money when it was down, for example, let's say you carved out another bucket of money that you could tap into when the stock market is down, well, that other bucket of money will give the stock portion of your portfolio time to recover. So in English, what I'm trying to say is, for my clients, when they retire, I create two buckets for them, an aggressive bucket and a conservative bucket. And which bucket do I dip into when they retire? Do I dip into the aggressive bucket and do I dip into the conservative bucket? Which one do I dip into? The answer is it depends. It depends when the market is up. It depends when the market is down. When the market is up, I dip into that aggressive bucket. The aggressive bucket, the growth of it provides the income. However, when the market's down, don't touch the aggressive bucket. Instead, draw your income from the conservative bucket. That's the ideal. Unfortunately, the TSB is not going to let you do that. When you draw money from your TSB, can you specify, I'm only drawing from my conservative money. Do not give me my aggressive money. No way. They're going to send you from both of them pro rata. That's a problem in the TSB. Okay? There's another problem in the TSB. As you guys may notice above, I mentioned that your Roth money is ideal for long-term growth. You should have your growth instruments in your Roth accounts, ideally. Now, here's the thing. In your TSB, if you want to have, let's say, a mix of stocks and bonds, can you specify that your stocks go into your Roth and that your bonds go into your traditional? No, you cannot. No, you cannot. Meaning, whatever allocation you choose, that mix of aggressive and conservative, that allocation is going to be applied to both the Roth and traditional, which stinks. So let's translate what this means. Theoretically, you could have G fund in your Roth. Now, for those who have heard this segment of my class before, you may remember that in the Roth, the whole benefit of the Roth is that the growth is zero tax. So if the growth is zero tax, what type of growth would you like in that Roth? Would you like that itty bitty G fund growth? Or would you like to have the stock growth, which you've seen in the past 50 to 100 years? Okay? So very important that you realize the limitations of the TSB. First of all, they have mandatory tax withhold, but that tax withholding might not be enough. You can request more. They have no state tax withhold, so keep your eye on that. Also, you may want to be liquidating your traditional money in the early years of retirement. This way, you pay the taxes on it, but in the lowest tax bracket you'll ever be in. And this way, you also minimize future RMDs. The Roth money, let it ride. Let it grow. Zero tax on all that growth. And realize the limitations of your TSB, that when it comes time to take money, they're not going to let you pull from the aggressive bucket, the conservative bucket. They're going to send you pro rata, which is unfortunate. Also, in the TSB, I'd like to let your Roth ride, but unfortunately, they're not going to let you. They're going to force you to have a mix. Whatever allocation you choose is going to be mixed into your Roth, into your traditional. So, just to summarize what we said, when you retire, you have income coming from the three legs of the stool. Every one of those three legs has a lot of nuance, has a lot of dynamism that you need to be aware of in year one, in future years, at the age of 62, at the age of 75. Okay, so just a quick review. When you retire, you're going to get shortchanged. Expect the shortchange for the first 3 to 6 months. You're going to need to have something to tide you over during this first 3 to 6 months. Your annual leave, expect to have about 50% tax withhold from that. Also, your fake Social Security, your Interim Checks does not contain your fake Social Security. Next, when you get your full pension, you're going to get the back pay of whatever they withheld you, fake Social Security, all that back paid. And when they back pay you, they're also going to withhold all the insurance premiums. So just be aware that first check that you get from OPM when they give you the real check is not even going to be your real check going forward, because they have to reconcile all the back payments. And also keep in mind that every year you're going to get a 1099 from OPM, 1099R, but the problem is in the first year, they're not going to do the math for you. So that means you're going to have to do some math on your own. A portion of your pension is non-taxable. And you also have all those deductions. The survivor benefit is pre-tax, but nothing else is pre-tax. Everything else is post-tax. And whenever you get a COLA, the COLA starts at 62. It does not give you a retro COLA. No, it starts at 62 and that's it. That's your first pension. Then you have Social Security. There's the fake Social Security and the real Social Security. The fake Social Security, no COLAs, and it has an earnings test, and it stops at the age 62 no matter what. When you turn to age 62, you lose your fake Social Security. Then you should decide whether you want to take the real Social Security. And as I mentioned, you probably do want to take the real Social Security, unless you're still working and you have the earnings test. Okay? Also, keep in mind that your Social Security, they're going to send you a 1099-R. Some of it's going to be taxable, some of it's not going to be taxable. Next, your TSB, 20% mandatory tax withholding, but no state tax withheld. Just keep that in mind. Also, the traditional TSB, that will be the go-to bucket, the go-to fund of money in the early years of retirement. While you're in low tax brackets, this way you pay taxes at a low level and you also minimize future RMDs. The Roth, let it ride. TSBs got some withdrawal issues. By the way, just practically speaking, when you request money from the TSB, it takes some time to get money from the TSB. It's not like you're going to have it, next day. So just be prepared for that. Okay, before I turn to the questions, let me just remind everybody that if you're interested in talking with me and my team, the way you do so is you click on that button on the side of the screen where it says Learn More. And that'll take you to a webpage where you can request a one-on-one. And by the way, if anybody's interested in requesting a one-on-one, a direct link, I'll put it in the chat box. Here it comes in the chat box. 1, 2, 3, and bang. So whoever's here, you can actually click on that link. It takes you to a web form, and we'll try to get you on our calendar as quickly as we can. Fantastic. Let me now turn my attention to the questions. I see that there's a number of questions in the chat box. So the first question is, okay, fantastic. Brad retired in January, and he's now getting his full pay in May. Okay, good. Good to know that turnaround time. Okay, very good. Brad, I don't know the details of your situation. I don't know if you had a complex situation or a very simple, straight situation. However, I'm hearing stories from people, and it goes both directions. Some people have a very easy career for them to verify. Some people have complexity. And I actually have one of my clients just told me recently that they have the easiest federal career possible. One agency, their entire federal career, and they have still not yet received their full checks. Fantastic. I see Alan has a question. What does FSA stand for? The flexible spending account. There is no FSA once you retire. David is asking, are COLAs cumulative when you turn 62? No. Bill is asking, is the fake Social Security back paid? Yes. Michael's asking, what is the process of getting your fake Social Security started if you took VERA and are eligible for it later this year, but we're not at the time of VERA? So it should really be an automatic thing. I don't think you have to activate it, but I have to admit that I don't know if they didn't activate it, I don't know what the steps would be. I think it's an automatic activation though, but I have to admit that I don't know if they didn't activate it, I don't know the steps you'd have to take. So Bill is saying that he's still waiting for his full retirement pay. It's been 4 months. What is the difference between RMD age 73 or 75? The difference is for those who were born 1960 or later, your RMD is 75. For those who were born before 1960, your RMD is 73. Shelly's asking, what happens to your FSA once you retire? And the answer is whatever costs, whatever medical expenses you incurred before your date of separation, you could submit for reimbursement. Okay. However, any medical expenses that you incurred after you separate, that there's nothing to do about it. Game over. Okay. Fantastic. I see Jim is asking, is the pre-tax deduction for survivor benefits reflected on the 1099-R? Yes. Yes, it is. Wayne is saying, great other things. Does it make sense to delay Social Security because of Roth conversions? No. Wayne, great question. I actually just posted an article about this. Okay. One of my articles is, does it make sense to delay Social Security to do more Roth conversions? And the answer is no. The reason why it is not worth it is because let's think about this. Your money is either going to be in the traditional or in the Roth. Okay. And let's just say your money's growing at the rate of the C fund. C fund, S&P 500, historically has been ballpark 10%. So that means whether your money is in the traditional or whether your money is in the Roth, that money is growing at a ballpark 10%. Now, here's the difference between traditional and Roth. In the Roth, you net all 10%. In the traditional, you don't net 10%, you only net 7%. So what that means is if you have your money in traditional Roth, it's growing at 7 to 10% net. Well, I have news for you. If you delay Social Security, guess whose money you're spending while you're delaying? So you are spending your own money while you're delaying. So that means you're taking money of yours that could have been growing at 7 to 10%, and instead you're spending that money. So you're losing the 7 to 10% growth. Now, what are you gaining with Social Security? With Social Security, you're gaining a higher benefit in the future, because we all know by delaying Social Security gives you a higher benefit. However, for those who have been to my webinars, been to my classes, we've done the math before. And when you delay Social Security, there is a rate of return. The rate of return ends up being somewhere to the tune of 2.88 to 3.1% rate of return. 2.88% to 3.1% rate of return. So obviously, the 2.88 to 3.1% rate of return that you're getting by delaying Social Security is not as good as the 7 to 10% rate of return that you'd be yielding had you left your money in the TSP growing traditional or growing the Roth. Meaning, even if you didn't do the Roth conversion, even if you left the money traditional, you're still netting 7, which is better than the Social Security 3.1. Okay, that's a great question, Wayne. Thank you. Brad is asking, who do we send our earnings statement to? So you're talking about the FERS supplement. There's a report. OPM has a document that you're going to need to fill out every year. So you send it to OPM. Bill is asking, retired in January 2026, 63. I'm turning 64 next month. I plan to delay applying for Social Security benefits. Okay, Bill, I don't know why you delay applying for Social Security benefits. When Medicare kicks in next year, where will the premium come? So you're going to have to pay your own. So Bill, basically what you're saying is you're going to be delaying Social Security and collecting Medicare Part B. So just so you know, Bill, for the record, those are two things I would try to discourage. But it sounds like that's what you're set on. So you're going to have to pay the Medicare premiums on your own. Yeah, they're going to bill you directly for your Medicare premiums. That's correct. Next is, I see Rita's asking, I retired in 2025. CSR is offset. Open my pension was less than what my federal agency had estimated. Ooh, I hear. I mean, I don't think there's a downside. Why would be a downside to requesting how they calculate the final amount? James is asking, it took 18 months to get my full pension check. Yikes. That's awful. Okay. Lori's asking, any strategies to keep your income below the 0% capital gain threshold for capital gains tax harvesting? So, Lori, it's going to be very hard to do that because your federal pension and Social Security alone are going to already bump you into probably the 15% capital gains bracket. I have to look at the numbers. I'm pretty sure the first couple brackets are 0-0, but then the third bracket, which usually lines up with the 22, that's when you kick into the 15. Not so simple. Not so simple. Okay, I want to thank everybody here for joining me on this class, and I hope that you all benefited from it. And as I mentioned, if you're interested in getting together, just click on that link and request the one-on-one. I look forward to working with you guys one-on-one. All the best.